My name is Michael Guyette, publisher of the Lead Lag Report. Joining me with Mark Tepper, who I know a lot of you have probably seen doing media rounds, especially with Fox Business. Mark, introduce to the audience, who are you? What's your background? What have you done throughout your career? What are you doing currently?
Yeah, what's up, Michael? Hey, thanks for having me, man. Appreciate it. A little background on myself. I have been a wealth manager now for a little over 20 years. I think I got into business at the end of 2001. I started off working for a few shops, which were a little too sales focused. They were, back then it was all about selling products for commissions. Jumped around to a few different places, eventually decided just to open my own firm. And I'm running just under a $2 billion RIA now, headquartered in Cleveland. I got about 25 to 30 employees across the country, work with clients all over the country. You may have seen me on CNBC back in the day. I did that from like 2010 through 2019. And then I hopped off CNBC and switched over to Fox at the end of 2019. So I've been on Fox Business and Fox News since then. Yeah, happy to be here to talk with all of you.
You find most wealth managers are just good salesmen in disguise?
Yeah. Dude, you know what? I mean, this business in general, you've got a bunch of asset gatherers, right? And they get compensated to go out and find assets, and then they plug their clients into a very passively managed portfolio of passive ETFs. They very rarely go overweight, underweight, even sectors, let alone pick individual stocks. So yeah, I mean, I think the majority of the industry, without a doubt, is made up of a bunch of asset gatherers who are good at, selling themselves, selling, financial planning or whatever it may be, but they have absolutely no clue about how to manage money.
Yeah, I mean, I'll tell you just from my own experience, and I present all over the country, presenting at CFA chapters, and I meet so many investment advisors, FAs, and I'm always blown away by the lack of real intellectual rigor in terms of the way they think about markets.
Yeah. So, look, I think there's something to be said about, having a team that's comprised of individuals who are actually living in the trenches, and actually studying stock research day in, day out, or like your strategies, following some sort of a rules-based investment strategy that can enable a person and a company to actually, cut through a lot of the noise and figure out what really moves stocks, what moves, macroeconomics, what moves individual company stocks, identifying whether or not there's dislocations in valuations. Yeah, I mean, I think it certainly makes sense to work with a team of people that actually know a little bit about what they're talking about, or hopefully quite a bit.
All right, so let's go with one thing you just mentioned, which is what really moves stocks. I think cynically, most people say, what really moves stocks is the Fed.
Yeah.
I'm a little cynical on that narrative myself. I often find the Fed tends to follow, not lead. And it's just interesting to kind of think through this in the context of what happened last week. We're going to bring it out to the macro and think about asset allocation broadly. But I want to get your take on what happened the last 5 trading days. It was a hell of a move for both stocks and bonds. I happen to think that, coincided with the name of the space, one of these is wrong.
Yeah.
So what are your thoughts on that?
Yeah, it's super interesting, man, because, investors overall have a very short-term memory, in my opinion. There's not a lot of people who, even if they've been investing for 20, 30 years, not a lot of them remember the 90s, the early 2000s. Most people, they remember what happened last year, the year before, maybe 2-3 years ago, max. And then that becomes their new normal. And then they start to apply that new normal into the future. And if you think about it, I mean, since 2008 or 9, when the Fed cut rates to zero for, maybe the first time ever, first time in a long time, people now believe that 0% Fed funds rates, that's normal. They believe that 3 to 4% mortgages are normal, and neither of those things are normal. I mean, that was kind of an anomaly kind of period that lasted from 2008 or 9 through 2021 before the Fed started finally hiking. I think we're probably closer to what normal looks like, maybe maybe rates a little lower from where they are now. But so there's this recency bias, this short-term memory that investors have, where they kind of conceptualize their own normal. And the normal over the course of that time frame has been the Fed put, right? As soon as the market starts to go haywire, the Fed's got to put, they're going to step in and they're going to protect the downside. And I feel like we've gotten past that to the point where that Fed put really isn't as powerful as it used to be. Maybe it's not even there. I mean, given the fact that inflation's still running at twice the rate of the Fed's mandate, I don't know that the Fed's going to hop in and just start cutting rates again. But that's definitely what investors follow. And when you see a disastrous payroll report, the jobs report Friday of last week at 150,000, and we can go into this later, but that 150,000 is a made up number as it is. So it's a low number if it were real, but it's not even a real number. So they look at that 150,000 jobs number and they're like, oh, this is great. This is like their Goldilocks scenario, right? This is where the economy is not moving into a recession yet, but the economy is not so hot the Fed's going to have to hike anymore. This is great. They're going to cut 4 times next year. And that's almost what's being priced into the Fed fund futures market right now. It's like, I don't know, maybe 3.6, 3.8 cuts next year. Now, if that's the case, if we cut 3 to 4 times next year, that to me implies recession. The Fed, I don't believe the Fed is going to cut rates just because investors expect normal rates to be a lot lower. I don't think they're going to do that. So you have that on one side of the equation. The other side of the equation shows that earnings are expected to grow just under 12% in 2024, corporate earnings, and again, another 12% in 2025. So look, there's no way both of those can happen. Somebody's wrong here. It's either the Fed fund futures or it's Wall Street analysts who are expecting 12% earnings growth over the next 2 years. So you kind of got to pick your poison, figure out which of the two are more accurate. Me personally, I'm a little more bearish. I don't see how we're going to hit 12% earnings growth the next 2 years, especially if a recession is in the cards for sometime in 2024.
Yeah, and actually it's interesting to just watching the way things played out last week. So it seemed like there was the hope that they're going to cut rates. That's why small caps started really rocketing.
Yep.
Right, because small caps are going to be most leveraged to that because there's a lot of zombie companies. There's a refinance,
no doubt,
coming, right? So, but yeah, and now it's only one day, but today that's reversing, fairly substantial on a relative basis to large caps. So it does make sense to me that if you're going to save small caps, you have to not have a recession, and you probably need to have rates a lot lower. But then again, it goes back to what you're saying: if rates are a lot lower, what's the implication there? So it does seem like the broader market's initial knee-jerk reaction doesn't make really much sense.
It doesn't. And as we've already covered, the market does believe that, the market moves in response to what they believe the Fed is going to do. I mean, you can definitely see that. I don't think that's right. I don't think the market has the right interpretation of what the Fed's going to do, but that's how investors have been positioning themselves. And I think that, unfortunately, over the course of the next 12 to 15 months, I think investors they're going to have to wake up to this new reality that normal that they thought was normal is not normal, right? And maybe a 4.5% Fed funds rate and mortgages at 6.5%. Maybe that's the new normal, or maybe that's the long-term normal. And I think investors are going to have to wake up to that because consumers overall have become very addicted to cheap debt over the course of the last 15 years. And that's addictive, man. I mean, you just look at all like the stimmy checks that people got, at the beginning of the pandemic throughout. And what happens when people are having free money dropped in their lap? And I witnessed this in Miami. Went on a vacation with my family down to Miami. And man, oh man, this is probably May of 2021. Man, oh man, did I see some people down there who I don't know if they'd ever been there before. I don't know how they afforded to get there, but I'd have to assume stimmy checks. And once you ratchet up your lifestyle, once you increase your standard of living, that's addictive. And it becomes very difficult for people to scale back and ratchet down when that supply of free money or that supply of cheap money is removed from the equation. And that is part of the issue I'm seeing right now. You go back to like last holiday shopping season in 2022, it was pretty decent. But normally come that following January, so January of this year of 2023, normally that credit card debt that spikes up in November and December gets fully paid off by the end of the month in January. In 2023, it did not get paid off. And that's the first time it did not get paid off since I believe 2008 or 2009. So what that means to me is that consumers right now, they're addicted to that cheap money. They're addicted to free money. They've ratcheted up their lifestyles. They're not quite willing to ratchet down just yet. So they're spending a lot on credit cards, and that, calls into question a whole different set of risks as we talk about potential credit events down the road.
Which is interesting because you would think that the higher credit card interest rate, the higher minimum payments, that at some point will cause a change of behavior. Maybe it just hasn't been in place for long enough to cause that habit to change. But it is interesting that you're entering, the holiday season, and guess what? Retailers still look like they've done absolutely nothing for a long time, outside of Amazon.
Without a doubt, man. And from a behavioral change standpoint, look, at some point you run out of Peters to rob to pay Paul. There's only so many Peters out there to rob, right? And if let's say you're in the lower quintile of household income, you're probably getting close to being maxed out on your credit cards. You don't have credit cards with $25,000 limits. Your credit cards might have $2,500 limits. And maybe you have 2, maybe 3 of them. And people is probably getting pretty close to being tapped out there. And that's why I think consumer sentiment numbers stink. That's why when you look at the small business optimism numbers, which, I'm a small business owner myself. Small businesses employ 50% of the private workforce. I'm a big believer that small businesses tend to be canaries in the coal mine as it comes to turning points in the economy. And small businesses aren't very confident right now. So, you look at all that stuff and it's like, okay, I think a lot of small businesses and consumers maybe as well are starting to realize that at some point we got to pay the piper. And it's not just the consumer that has to pay the piper, or the US government has to pay the piper. Corporate debt that needs to be refinanced at higher rates. Corporations got to pay the piper. So, this end of an era of free money or cheap money, it's going to wreak some havoc, in my opinion.
Talk about how you implement that just on a firm level. So you've got the $2 billion in assets. Is it being run according to certain models? Every advisor has their own style. What's the makeup of the way decisions happen?
Yeah, right. So it's all company based. We have 3 individual equity strategies that form kind of the crux of every single one of our clients' portfolios. So it's either a select equity strategy, which is more of a growth at a reasonable price. We have a growth and income strategy, which is essentially a dividend strategy. Every single company in there has to pay a dividend or else we can't consider it for that portfolio. Typically more for like our pre-retiree or recently retired clients. And then we have a contrarian strategy. That's definitely much more bearish, did very well last year, underperforming this year because this year, you've got 7 companies that have the market up, maybe 10, 11% so far year to date. But we have those 3 different strategies. And within those 3 strategies, at any given point in time, the maximum amount of cash we can hold in any of those 3 equity strategies is 20%. Okay. So I want everyone to understand that when you're managing, we're not a hedge fund. We do not go all in on our base case by any means. Since I'm bearish, that does not mean I'm 100% in cash. That does not mean I'm only in consumer staples, utilities, and healthcare companies right now, right? It doesn't mean that. We still have to manage diversified strategies. Most we can have within each of those 3 equity strategies is 20% cash. We're probably about halfway there right now. We're probably at about 10. But then outside of those equity strategies, if we have clients that are more bearish or more conservative, we might have 50% of their total money in cash outside of that strategy. You see what I'm saying? So it's not just about how much cash we have within the strategy from a balance sheet standpoint for the individual client. It's more or less, kind of looking at it and saying, all right, well, we're pretty bearish, but we still want to have you in this growth and income strategy or our value strategy or our growth at a reasonable price strategy. So we're going to build up some cash reserves over here on the sideline. But we can never, ever, Michael, we can't go all in on a bearish call. We can't go all in on a bullish call. We have to be selective. We have career risk with every single investment decision we make. And, if the market's up, let's say it finishes up 12% this year and we're down 10% because we took a very bearish position, we will lose a lot of clients. If the market is up 12% and we are up 10%, our clients are, they're probably going to be okay with that we're in the ballpark. If the market's up 12% and we are up 24%, some of our clients might thank us, but they're not going to be beating down the door and pounding out the phones, calling us to thank us, So I just want to be very clear, as a diversified wealth management firm, we'll take our base case scenario, which is bearish. That'll cause us to overweight more defensive sectors, identify companies that fit our thesis, maybe with pricing power, strong balance sheets, high levels of cash, low levels of debt that need to be refinanced. We'll incorporate all that into managing a strategy that still begins with the S&P sector weightings as a starting point. And then we overweight, underweight from there, and then pick individual securities in each sector.
How challenging has it been to manage expectations with clients this year? I mean, I talk to advisors all day long, and everybody's got the same problem, right? You have any kind of asset allocation mix, you're underperforming the S&P. The S&P is largely 7 names. Most stocks have really done nothing all year, totally counter to the pre-election year cycle dynamic to begin with. And most individual investors, I mean, you can probably attest this directly, they don't understand nuance.
Yeah, they don't. And I'll tell you personally, when you look at our portfolios and you look at the market capitalization of the 7 biggest companies, we definitely do not hold all of them at their weightings. I mean, I think we're pretty far underweight Apple in particular, which is the biggest weight in the S&P 500. I don't see that it's really worth a 27, 28 times forward multiple when they really haven't innovated for over a decade. They've become more of a company that focuses on financial engineering at this point than product engineering. And I really can't see how they're going to be able to continue to trade at that multiple. And I do expect that at some point they're going to have to re-rate lower. And in fact, if you kind of go back through, every single decade, I mean, you go back to the 90s, what was the key theme? Well, it was probably personal computing. Who were the biggest performers? Probably Hewlett Packard, right? HP. Then the following decade, they didn't do as well, right? And there's always those kind of key leaders. I think Apple was probably, the company of the 2010s. And now you look forward into the 2020s, and I think that big theme is more or less going to be AI, as we've seen play out so far this year. But when it comes to managing our clients' expectations, look, our job is to manage risk. And I think with a lot of, based on what I've read from you, Michael, and I don't know everything about your strategies, but it seems like, you do a very good job managing risk as well. And sometimes we are
not to cut you off. This is an important point. The concept of managing risk the last 2 years has been upended because, as you know, as we all know, right, you haven't seen that counter, not in terms of necessarily stocks and bonds, but in terms of treasuries against credit spreads widening, which we'll talk about at some point. But that's been the missing ingredient for really managing default risk, which is yet to come.
Yeah. I mean, I think there's a lot of key issues or potential issues on the horizon out there right now. But, the whole client expectation question, kind of getting back to that, it's a tough one to manage. I mean, we don't have Apple as a 7% position. We're probably, we hold somewhere around, like, depending on the strategy, somewhere between 40 and 60 stocks in each of those strategies. I think our largest holding in any of them is probably maybe 3-ish%. So we're definitely not at 6-7% Apple, Microsoft, or anything like that. But when you're looking at this market this year, to your earlier point, if you owned the other 493 stocks in the S&P, according to their cap weightings, you're negative this year. Like the Magnificent Seven, a few months ago, I was talking about how they contributed 80% of the year's market returns. It's 100% now. Or at least last time I checked, Thursday or whatever last week, it was over 100%. So, and this is, in my opinion, what's going on right now is this isn't a, blockbuster economy. It's not a blockbuster stock market. This is the entire move of the stock market this year just seems to be fueled off the AI frenzy, the AI hype. I don't know how long that'll remain the case. At some point, the novelty of that could begin to wear off a little bit. I do think it's a big theme over the course of, the rest of this decade. But, at some point, investors are going to want to see the results from AI. They're not just going to pay a higher multiple because of the dream. And that's where managing client expectations becomes, a little difficult. Fortunately, and I don't know if how many other people on this meeting right now are wealth managers or whatnot, but it is important in our business to set reasonable expectations up front and to make sure you're working with the right clients for the way you specifically manage money, and maybe you're working with people who they tell you, look, man, all I want are singles, maybe the occasional double. I don't want to strike out. I, as a wealth manager, then have to decide, okay, is that a good client for me and my strategy? Yeah, he could fit one of our strategies, right? So I think a lot of it is really, all right. So one of your first questions, a lot of people in this business are salespeople and they are good at gathering assets, and they will take any assets that will walk through the door. Anyone that can fog a mirror, they will work with that person. Having, been in this business now for over 20 years, I want to do the right thing for the client. And it's amazing how it actually works, Mike, when you're looking to bring on new clients. When you start to qualify and disqualify prospective clients and ask the questions to figure out, do I have the right solution for this individual, for this family, or would they be better off going elsewhere? And when you really actually in that prospecting process, try to focus on what do they want and do I have that as a solution to their problem? I think you're going to have clients that have very realistic expectations and they're going to be, quote unquote, well-behaved clients for you.
Of course, we have to invest going forward. So just going to the GARP, growth at reasonable price side of things. Has it been harder or easier to find, growth at a reasonable price type of stocks in this time environment?
It's been hard. Those 493 companies are negative on the year, right? And no matter how much we tell clients that this is not an S&P 500 strategy, right? That's not what this is about. The Main Street millionaire client, someone's got $1 million, $2 million, maybe $3 million bucks. All they know is the S&P. So no matter, they're always going to hold us somewhat accountable to the S&P 500. But yeah, it has been harder to find those growth at a reasonable price companies. Valuations have certainly been a little bit out of control, a little bit out of whack. But hopefully we start to see better opportunities over the course of the next few years. I think one of our best picks so far this year from a performance standpoint has been Cameco, which is it's the largest sourcer of uranium in North America. So we kind of started to diversify our energy position away from just your standard oil and gas plays and started to incorporate more like, nuclear, right? I mean, that's kind of our quote unquote clean energy play, Cameco. And that's been a home run for us. But, for every home run like that, you're going to have a lot of singles, doubles, and you're going to have some strikes, right? I mean, no matter how great any investment manager's process is, their research is, nobody picks them right all the time, and there's always going to be mistakes. And I think one of the keys in managing risk is being able to call out your L and take an L, sell the damn thing and move on, right? And live to fight another day.
On the contrarian side of the different portfolios you're running, what are some of the bigger, more contrarian things that you're putting some positions on?
I don't run that one. I'm less involved. Colin Simons, who's actually on the meeting right now, he runs most of that. Let me see if I can find a few of the positions in here. So this happens to be, we actually have consumer discretionary at a 0% weighting right now in that value strategy. Obviously, the consumer being tapped out plays into that thesis. Definitely very heavy on defensive. So healthcare, consumer staples. I mean, healthcare and consumer staples are the two biggest sectors in here. We're talking about almost 45% weighting in those two sectors. Now, those two sectors are down on the year. They are consumer staples, healthcare, utilities are probably 3 of the 4 worst performing sectors this year. Throw in real estate and you got all 4 of them. However, when you start to look towards positioning for next year, healthcare is probably my favorite sector for next year. So, a few that we've gotten here, let's see, Biogen, Cigna Group. So, there's a few names that you don't always hear the Wall Street analysts talking about. You probably don't hear much about these kind of names on CNBC. They're not quite the household Merck, Pfizer names that everyone's familiar with, and Novo Nordisk, which everyone's become familiar with in this Ozempic obsession that the country suddenly has. So, they're not small names by any means, but they are some names that are, not quite your big, huge, super duper big pharma household names.
So everybody, please make sure you follow Mark here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, it's will be a podcast under Lead Lag Live. So I got to give you credit, Mark, because I've seen some of your segments on Fox. I've done the Fox business side. I used to actually be on with Maria Bartiromo on the floor for many years.
Oh, no kidding.
You see,
Nice.
I used to interact with her quite a bit. But one thing which strikes me, and I give you credit actually for taking this approach, is it seems to me that you go beyond just talking about markets and investing. Some of the commentary is political, some of it is
Yeah.
outside of sort of the standard thing. And in our business, that's often kind of, I think most people shy away from that because they want, to your point about asset gathering, right? They want all kinds of assets and clients, and they don't want to say something that might offend a prospective investor going forward, right? So they tend to not put their voice out there and provide an opinion. Was that always sort of your approach to media, or is that kind of a more recent way that you're putting yourself out there?
I want to say, all right, so I started doing CNBC, I think in like 2010. And I got to tell you, man, I sucked at it. I was terrible. I was so concerned about the information that I was communicating. That's all I cared about. I didn't care about how to deliver it, how to make sure it, people understood it. It was PE ratio this, it was rough. Probably around 2015 or 2016, I'm like, man, this sucks. I'm only doing this like once or twice a month. It really took a lot for me to kind of take my client servicing hat off and put the CNBC hat on once or twice a month. It was difficult. It'd take a lot of prep to get ready for those, to make sure I was on my toes and ready to respond. So I actually quit in 2015 or 16 for the summer. Didn't expect to hear from them ever again, but they reached out like in September of that year. And they're like, hey man, summer's over. Can we get you back on? And can we get you on every week regularly? And I'm like, oh, okay. Well, sounds kind of cool. Like at least I can gain some momentum if I'm doing it every week, and doing it once a week or twice a week or 3 times a week. It was going to take the same amount of work that it was taking me for me doing it once a month. So I made the decision at that point. All right, if I'm going to do this, then I'm going to do it my way. I'm going to say whatever the hell I'm thinking, whatever I'm feeling. Some people are going to love me. Other people are going to hate me. And that's okay. I'd rather go through life like that than kind of being right down the middle of the fairway every time. And everyone's like, yeah, he's an okay dude. I don't love him. I don't hate him. He's all right. So I didn't want to do that. So I lost the tie, started wearing, louder sport coats, and just made a decision to say whatever I was feeling and to really be authentic and to approach TV in the way that I've approached life since, probably right after college, where I wanted to go through life like a magnet, right? Be myself, and you're going to attract people that you want to be around, and you're going to repel, just like magnets do, people that you don't want to be around. And, that was all part of, kind of the transition from the Obama years to Trump to people, on Twitter, when it was called Twitter, saying he's not my president. And then that going to Biden. Politics influences money. And we subscribe to political research, which helps us to take certain positions in our portfolios. I mean, you don't just hop into Cameco Energy for the fun of it. There has to be some sort of green energy research that you've read, which says that solar farms are twice as expensive as nuclear, that wind farms are 3 times as expensive as nuclear. Nuclear is the most efficient way. There's got to be research that's out there. And for me, I want to let people know what I'm thinking. I'm not going to beat around the bush. And that is going to help me to attract clients who think similarly and who want those views reflected in their investment strategy. So by taking that strong position, I'm going to turn a lot of people off. I'm going to push a lot of people away. But those people that are remaining, they are going to be raving fans of what I do and what my company can do for them.
Which makes total sense. I've used that line before: better be loved by few than liked by many.
Yeah. That's
right. Yeah. Get those really hardcore fans, right? But I think there's in that transition where some of your existing clients surprised, cheering you on. Did you lose any? Because that's not easy. I think when you're trying to build a business and you've established yourself as this professional, and suddenly they see you, talking in a way that may not be what they perceive as professional. Yeah, look, there have been some clients that we've lost along the way because of that. There have been some prospective clients we've lost along the way. We have an advisor who spent several years building up a Bay Area office for us. Great advisor, very smart dude, CFA, lots of experience doing due diligence on alternative investments and things like that a lot of these, higher net worth people are interested in, especially out in the Bay Area where there's so much talk about, venture capital and private equity and things like that.
And there were competitive situations where the prospective clients were not on board with our political leanings by any means. So, we've lost a few, but we've gained a hell of a lot more than we've lost. I think it's been a good move for us as a firm. We've kind of positioned ourselves as a firm that if you are, at least right of center, you're probably going to agree with our political research, which will be reflected in our holdings in every single one of our strategies. And look, I think at the end of the day, you lose some, but you win a lot more.
Yeah, like that. I give you credit for it. I'm very public in saying very clearly what people see on X as a persona. I'm obviously much more professional when I talk to people one-on-one, but
oh yeah,
there is something to be said about sort of being consistent both on the persona side and on the one-on-one conversation side.
Without a doubt, man. Yeah. And on X, sometimes you're trying to just create a character, right? Sometimes I'll put things out there. I'm like, all right, like maybe it'll be a hit. It's going to ruffle some feathers. It's going to poke the bear a little bit, but yeah, when I'm talking to a client face to face, it's more or less like, I get it. Like I hear where you're coming from. I disagree. I think this is so. Yeah, I think you're a little more delicate in the way you're communicating when you're sitting across the table from a client face to face.
I am curious. I mean, getting to $2 billion, it's not huge, but it's certainly not small. And the wealth management side of things, what was that journey like? Was there a set of years where it just kind of really exploded? The referral side of the business is often how you raise assets, but that's a very big grind, right? So how do you get to $2 billion?
Yeah. And I've probably sold off about, in today's dollars, I would assume 500 to 700 million over the course of that time frame. And that was advisors who we had to part ways with. They were no longer a good fit for our culture and sold them their books on the way out. Kind of cleared those people out of the company along the way. But look, we are a firm that we have built ourselves so that we can employ those asset gatherers that I talked about, who can go out there, teach seminars, talk to the people that reach out, through the website or call us because they've seen me on TV. We have those asset gatherers and they let the prospective client know they're not the expert. I'm here to be your relationship manager. So we have those people going out and we've built the team behind the asset gatherers to make sure that the asset gatherer gets to do what he or she does best. And that is talk to prospects and clients. We have a team of 5 CFAs. We have a team of 5 to 7 CFPs building out the plans and looking at asset allocation and things like that. We have an in-house JD. We have an in-house CPA. So what we've done, Michael, is on the wealth management side of things, we've taken more or less like the family office model, which the multifamily office model typically available for people that have at least 10 million, if not 20 million or higher of investments to bring into that firm. They get, kind of a one-stop shop for their legal issues, for, their tax issues, bill pay sometimes. That's all part of the multifamily office model. We've kind of built that out and democratized it. And we've made, let's say, 80 to 90% of what those multifamily office models provide to their $20 million clients. We are providing 80 to 90% of that now to the Main Street millionaire that has a few $1 million. And we've kind of carved out a niche for ourselves. Those are our bread and butter clients. That's really what keeps the lights on. Me personally, I tend to work with people, 5, 10 million and above. But as a firm, we're working with that Main Street millionaire. And I think our value prop to those clients it's pretty strong, and then again, just the way the firm was set up, like I said, allowing asset gatherers to be asset gatherers and not to be salespeople who pretend like they manage money or pretend like they can build financial plans when they really don't know anything about how to build a plan or pick a stock. Dummy down. Tell people you don't know the answer to that. You'll bring the smarter guy into the next meeting, and people respect that. It works wonders when you're actually just an honest human being and you do what you're best at and you have a team behind you that can help out in the areas that you're not strong in.
Do you have sort of a bigger, longer term vision for the company? I'm just curious. I mean, obviously you want to keep growing, but there's headaches the more you grow, right? So is there some point where you say to yourself, you know what, I'm comfortable. I'm going to think about other things to do or just coast and enjoy life, or talk about sort of your own ambitions?
Yeah, so we're going to keep growing it. I'm wired to win, man. I'm very competitive. I love to win. I was a high school baseball player, college baseball player, pitcher, tore my rotator cuff freshman year of college. So I was done after that. But I just love to win, and I'm not done winning. I don't know. I'm 43 years old. Maybe when I'm 60, I'll think about hanging it up. But, I intend on making this thing as big as I possibly can. I was in Tucson, Arizona a couple weeks ago at this retreat, like a wellness retreat that I went to with a group of business owners that I've known for 15 years now. And I started to do the math on what it would take for me to become a billionaire one day. And I started to do the math. I pulled out, the old financial calculator, and I'm like, it's only like 17% growth per year. I can easily do that. Right. So look, I've got big ambitions. I don't know that, being a billionaire is really what I need to do in life. I don't know that it's really what I want to do, because obviously, Michael, as you know, man, as you're building a company, as you're building investment strategies, you never have perfect work-life balance. Nobody ever does. There's a lot of people that talk about, striving for perfect work-life balance, but nobody really ever has it. You're either working too much or you're living life too much, and it's kind of like a seesaw, a teeter-totter, right? You kind of go back and forth. But yeah, I mean, from a long-term perspective, look, man, my kids are 16, 14, and 12. Maybe at some point, one of them will want to join my company. They will not be given my company, but they can certainly join and learn and things like that. So, I think being there for that mentorship could be kind of cool. But at the same point in time, man, I don't know if you have kids or not, but I also am not going to try to convince any of my 3 kids to enter the wealth management business, the investment business. If they want to do it, the door's open, they can certainly come in. And I'd love to, spend some extra quality time with them on the business side of things. But I want my kids to pursue something that they're passionate about. So look, continuing to grow it, I'd say I got another, 15 plus years in the tank, and, we'll kind of see where it goes from there.
Okay. I did see, Mark, you've got a couple of books as well, if I'm not mistaken. I am curious about that. It's not easy to write a book, let alone several. So talk about that process, and what was sort of the objective in wanting to write books to begin with.
So I talked about the wanting to be a magnet, right? The way I kind of live my life, the way I've approached my media appearances, and just the way I communicate with prospective clients. The very first book I wrote was Walk Away Wealthy, and it was geared towards business owners that I had been working with for years. So I belong to Entrepreneurs Organization and Young Presidents Organization. So there's probably 50,000 business owners around the United States that belong to those 2 organizations. And what I noticed was that a lot of business owners, they were running companies worth $20 million, $50 million, $100 million. And they really didn't have much in the form of liquid investments. These are guys who, their EBITDA is $7 million a year, and, they're sitting on a couple $100,000 in their 401k. And I looked at that and I'm like, man, they've got different challenges than that Main Street millionaire. And they do. These are people who they've got this business they've built. And then one day, $50 million falls in their lap when they decide to exit and actually have a liquidity event. So I wrote that book for them. I said when I was done, I'll never write another book. And look at me now. I've written 2 more after that. And I've got another one on the way called Bidenomics Exposed, which should be out in January, which just kind of talks about a lot of the economic policies that are in place right now and how they are setting us up to actually reduce our returns over the course of the next several years if we don't correct those policies. The latest book I wrote was by far my best and my favorite. It's called The Money Playbook. Wrote that for professional athletes. I actually had a big time NBA player who was a multiple max contract guy reach out a few years ago. Flew down to see him. He picked me up in his Rolls Royce from the airport, and we're going to dinner to meet with him, his agents, his team. And while I'm sitting in the passenger seat, he took an investment call from a guy. Some guy was pitching him on something, and he didn't know what he was doing, didn't know how to respond. And I'm like, man, these guys, man, they're getting pitched investment ideas, invest in their buddy's bar, some dumb ideas all the time. And they don't really have a buffer. They don't have a personal CFO who can kind of vet those opportunities and be comfortable being the bad guy, right? no, he's not going to invest in this. So I wrote that book, by far my best book, very entertaining. Most of the people listening right now are probably not professional athletes, but look, I think it's a great book. You can apply everything in that book to, someone that's got a just normal run of the mill job or owns a business today. Fun book, but it is hard, man. And the issue is it takes a lot of time. And with this Bidenomics Exposed book, I'm grinding on this one right now because it's time sensitive. With the Money Playbook, man, I think that took me like 3 years during the pandemic to write. It was okay because nothing in there was that time sensitive. Bidenomics Exposed, from what I can tell, there's about 365-ish days until the 2024 election. So, this thing, I got to make sure this is out by January 1st so that it's still relevant. And that one has been one hell of a grind because I've been working on it now for about 3 to 4 months, really hard. And this, assuming I can get it done and ready to go by January 1st, this will have been the fastest turnaround on a book ever for me, which is, it's tough because it's not my full-time job. Obviously I'm doing others. Running a wealth management firm is my full-time gig. So it's a project on the side, and hopefully it draws some interest. And obviously, Michael, as you're probably aware, the main idea of all of these books I've written, and including Bidenomics Exposed, sure, it's to educate people, but I also I might get clients out of it. I'm not in the business of selling millions of books. First of all, I would never be able to sell millions of books. Second of all, not a lot of people who do that. And I don't know how much money you'd actually make if you were, even not a New York Times bestseller, but let's just say a Wall Street Journal bestseller. I don't think you could make a career out of just doing that. So my main goal is to educate prospective clients and hopefully get them to want to move the ball across the goal line with us and engage in a conversation.
The question that I was trying to ask, he sent me a DM. It's actually, I think, a good one in terms of just the industry. Said, large language models look like they can automate most repetitive rules-based tasks, tax, asset allocation, bill pay, etc. As those back office tasks get automated, how do you see your business and the industry evolving over the next 5 to 8 years?
That's interesting. I just saw over the weekend that ChatGPT failed the CFA exam. So I think we've got a little bit of job security right now. But yeah, I mean, look, I think a lot of, industry wide, I don't know yet how to incorporate all of these language models, artificial intelligence, machine learning. I don't know yet how to incorporate all of this. I've got a buddy who's actually, he's part of this conversation right now, who he's got a pretty badass machine learning system that he was using. And I'm probably going to re-engage a conversation with him to just figure out, what it would look like within our business. But I'm going to sidestep this question a little bit and say that I think there's a career path. There is a future for entrepreneurs who want to get into artificial intelligence consulting, right? And meeting with wealth management firms and saying, hey, we already know all the different language models and this and that, machine learning, AI. We can help you to integrate all of these into your business. So I don't know yet. We are just kind of starting to explore some of these opportunities, but I'm sure it's going to change the game. And I think the best way for us to figure it out would really be for some consultant to be able to help us, along the way. I doubt it's going to happen anytime soon. But, look, we want to stay on the cutting edge of all this new AI technology. I do think, from one standpoint, though, once I'm concerned about this within our industry, once everyone is using AI to pick stocks, to, sell out of stocks and move into treasuries or whatever their model is, when everyone has access to the same information, how do you outperform? That's been my question. So I'm a little concerned about whether or not it's going to still enable us to outperform. And I'm sure it will. I'm sure it's just kind of, a fear of the unknown thing for me. But we're at the point now where you're beginning to see some opportunities with those different technologies, and we're just hoping to start trying them out probably as we kind of roll into 2024.
Mark, for those who want to track more of your thoughts, more of your work, aside from X, Fox Business, any other places that you'd point them to?
Most of my communication is done on X. So yeah, just give me a follow there. I'm going to be rolling out a new podcast. I've done weeklies in the past and then just kind of pulled myself away from them because I wasn't able to stay in touch. But it's called Fired Up. Mark Tepper's Fired Up. It will be coming out January 2nd, January 3rd. So stay tuned for that. But yeah, most of my communication will continue through X. So follow me there, Mark Tepper, SWP.
Again, folks, this will be in the podcast probably a couple of days here. But please give Mark a follow. Check him out, obviously, on Fox Business when he's there. And hopefully I will see you all later in the week on a number of Spaces Wind Up podcasts. Thank you, Mark.
Appreciate it, Michael. Talk to you soon, man.